now. All right, welcome everybody to Team Play Hard's Monday night weekly team call. Thank you so much for joining live. Thank you for watching the replay. We're super excited tonight because we have a special guest, and it's nice that you guys don't have to hear from me as usual, but it's also, this is a really important element to our business, something that you business builders, you business owners, you ought to learn about, you ought to wrap your mind about, and I'm right there with you. And so I hope you all brought a pen and paper and that you're ready to sit up straight and eagerly learn from Joseph, who is a CPA. He was referred to me and my family through Kara Churchill. Those of you guys that know Kara, she is part of a group, I believe it's called BNI. I want to say BMI, Body Mass Index, but BNI, Business Networking something. And they help each other. They help promote one another's business. Katie Burchett is in something very similar in our town called Mob, and it's smaller, it's cheaper, and it's, I think, women only maybe. And then Kristen DeVoe is in something similar in Salem, Oregon. Speaking of Oregon, Joseph is a CPA in Oregon. I'm sure he will mention this, but for example, Jake's in California, Dana is in Georgia, and some of our team is all over the map. So of course you'll want to check with your states, and Adele's in Kansas. So we are a little bit, most of the team though, however, half of our team is Oregon based. What else do I want to tell you guys before we start? Basically, Kara referred Joseph to us because he is a CPA, and you guys, we need to be managing our finances well, and knowing we want to do right, and we want to pay Uncle Sam what Uncle Sam is due, but we also want to be able to maximize what we're able to write off. And, you know, there's quite a bit, I hope, that I write off. Hopefully that is good to write off. So I'm super excited to learn. I think we're going to go about half an hour depending on Joseph's schedule. We typically do, but we would love to be able to do a little question and answer at the end if his schedule allows for that. So without further ado, I'm going to mute myself and turn it over. And Joseph, if you could just introduce yourself, tell us who you are. Kara sent me a photo of you because I always post the link to our call with a picture, and it looks like you have a huge family, a huge, beautiful family. So tell us a little bit about you, and then teach us what we need to know about paying taxes for this thing that we do.
Okay, yeah. So again, my name is Joseph Lewis. I work with Eisler CPA here in Eugene. What else to know about me? Yeah, I actually do have 7 children. It's a huge family. I tell people my wife's so pregnant. She's so fertile. I just look at her and she gets pregnant, it seems like. But she says she does love being married to a tax accountant, because if she ever has trouble falling asleep or insomnia, she just asks me how my day was at work, and boom, she's out like a light, you know. So we live here close to Eugene. There's a little bit of an intersection, of course, in business consulting and tax accounting. So we're going to touch on both, how we can best legitimize your business and IRS proof your business. When you're starting your business up, there's going to be a lot of costs, and you'll need to divide those costs into organizational costs and into startup costs. And the distinction there is your organizational costs, you can take up to 5,000 of those as long as they're under $50,000. The organizational costs are costs like the attorney fees, the LLC, things that you only need to do once generally to get your business going, to get your business off the ground. The startup costs, on the other hand, are costs that you incur before you start selling your first, a lot of times I use the proverbial lemonade stand because it's the easiest example. But before you sell the proverbial first glass of lemonade, what are some of the costs that you have that you will continue to have once your business is operational? So, I don't know what kind of commissions or fees or expenses you have that will be ongoing once your business is going. But even before you have made your first sale, you'll have those startup costs that will be consistent with costs that you have after your business is going. So you can get up to $5,000 of those costs too. Now the IRS is very concerned that people are going to be creating sham businesses and taking, in this case, $10,000 worth of expenses, offsetting their W-2 wages. And so, heck, if you're in a 25% tax bracket, you just save $2,500 in taxes by offsetting your $10,000 from maybe your husband's or your wife's W-2 income. And then there's additional savings, obviously, because of the state tax consequences. So they're always looking for if you have a legitimate business or if it's a hobby. So anytime you're dealing with the IRS, you don't want to use the word hobby. That's a bad word, because any word that is any expenses categorized as a hobby would be disallowed. And the IRS can go back into your tax returns and disallow the last, they'll go into the last 3 years for their statute of limitations. If they audit you, and they would disallow it, they would subject you to all the penalties and interests that they can for taking bad expenses. So again, we want to make sure you're a legitimate business. And I want to give you 6 key elements that would legitimize you as a business that the tax courts have looked at to establish whether a business is legitimate. Number 1, you need to have a business plan. Now, it doesn't need to be a 20-page bound notebook or anything like that. Take 2 pages, a handful of paragraphs, and make sure you have something legitimately written that is a business plan. And it should include things like what the product you're selling is, who some of your key customers are, how you intend to advertise to those customers, how you price your products, things like that that show that you're a legitimate business. Again, that's what your business plan is going to look like. Now, in all of this, the documentation that the IRS looks at, so just kind of a big picture, and let's just call this the second thing, is in real estate, they say location, location, location. In tax accounting, we say document, document, document. And not just have documentation, but have what they call contemporaneous written evidence. So at the time that you created the business plan, you properly documented it, not waiting until you're under audit and you're under the distress of the audit. The IRS doesn't want to see something you created at the last minute. You should have timestamps on your documents if they're electronic, or if it's a paper document, it should be legitimately probably dated and have a little bit of wear on the paper if an auditor ever asks for it, because it's contemporaneously written. So the next thing after your business plan is having some kind of accounting system. When you're first starting out, I have some clients that use big, long ledger paper, and some will use an Excel spreadsheet. Once my clients get more sophisticated, they'll want to use QuickBooks. That's the most common. But you should have the date, the description of every expense or income item, and a categorization of it. Because when it goes on your tax return, it's going to go in a specific category. So if you file your own taxes, it's probably going to be on your Schedule C. So that's the next thing we're going to talk about, is what kind of entity you have. And for the purposes of your businesses, you'll probably do one of five entities. The most common will be a sole proprietor. And this is the one that gets reported on your Schedule C. It's just in the back of your 1040. It's the cheapest. It's the easiest to do. Any losses you generate on that Schedule C will flow directly onto page 1 and offset your W-2 income if you have losses, or the income on there. Now, the problem with your Schedule C income is that it's earned income, and earned income is subject to self-employment tax, and self-employment tax is 15.3%. So every $100 your business earns, in addition to the ordinary income rates that can go from 10% to 39.6%, in addition to that, you're going to have this 15.3%. You all are familiar with the self-employment tax. It's also called your FICA. It's also called the payroll tax. It's mostly Social Security. But if you have a W-2 job at McDonald's, for example, you would get hit with the FICA tax, is what it's called there, not self-employment tax. It's 7.65% to the employer and 7.65% to the employee. But since you're business owners, you pay that tax combined, that 7.65 per each, and you pay that 15.3% together. Okay, so really making sure you've got a lot of good expenses to offset your business income is going to be helpful in eliminating that. And depending on how much you're earning, you're going to want to do a different entity. So the sole proprietor is the most basic and easy. And when you've got very little income, you're generating losses, that works fine. I would encourage each of you, if you don't already have it, set up an LLC. Now you might be saying, well, I don't want an LLC because then I have to file a separate tax return. If you are a single member LLC, you don't have to file a separate tax return. It all flows directly onto your Schedule C. The IRS says that if you are a single member, it's a sham entity. It's a disregarded entity for tax purposes. It gives you some level of liability protection, and it can give you some tax advantages if you're earning enough money. But for our purposes, it's just all going to end up on your Schedule C in the back of your 1040. So the nice thing about the LLC, it's a state designation. So whichever state, whether you're Kansas or Oregon, every state in America has them now. They started out in Wyoming about 20 years ago, but every state has them now. And the nice thing about an LLC is it can choose how it wants to be taxed. Like I said, if you don't take any additional action, you're going to be taxed as a sole proprietor. But how else would you want to be taxed? Well, you could also file the Form 2553 to be taxed as an S corporation. Why would you want to be taxed as an S corporation instead of as an LLC? Again, the LLC or the tax as sole proprietor, everything is subject to that 15.3% of self-employment tax. When you have an S corporation, you can play this game where you say, aha, part of my income is my earned income subject to that tax, the payroll FICA tax, but the other part of my income is passive income. So you think, what is passive income? How can I get passive income? The quintessential, most prime example of passive income is a rental real estate. Some of you on this call probably own rental real estate, and you're thinking, I never pay self-employment tax on your rental real estate. Of course you don't, because that piece of real estate is generating all of your income. You're not, presumably not out working for that income. That piece of real estate is generating your income. So how do we apply this to Beachbodies? What kind of income can you say is passive income so it's not subject to the self-employment tax? Well, you might have a client list that you've built up over time. So that becomes income that's more passive. You might have a computer that's helping to generate income. You might have other assets that you have in your possession that are generating the income, so the income feels more passive. So then your next question is, well, gee, if the passive income is not subject to self-employment tax and the earned income is subject, then I'm just going to categorize all of my income as passive income and none of it as earned income. Now the IRS is on to you there because they expect and demand that you pay yourself a reasonable wage. Well, gee, what's a reasonable wage? You would know better than I do what a reasonable wage is, but some of the things that the IRS is going to look at is what a reasonable wage is. Number one and most important to them is what excuse me, what do comparable professionals in your industry that are doing the same type of work earn? Another thing they look at is what is the level of education that you have? What is the level of sophistication of the work you're doing? How many hours are you putting into it? So really, if you are a sole breadwinner of your family and you are working full-time at this, it's going to be pretty tough to convince the IRS that you have a salary of less than $30,000. So I typically tell my clients, you probably don't want to do an S corporation unless you're making at least $30,000. And even then, probably closer to $40,000, because if you're filing an S corporation, you don't get to put it on the back of your 1040. You have to file a separate tax return, because the S corporation has to file a Form 1120S. So now you've got two tax filings. And your CPA is probably going to charge you $800 to $1,000 to file that separate tax return. But that's okay, because if you can take $10,000 of that income that's not subject to self-employment tax, in other words, you made $40,000 and you have $30,000 of wages, you have $10,000 that's passive income that's not subject to self-employment tax. How much taxes did you just save on that? 10,000 times 15.3%, $1,530 by playing that game. So you come out ahead if you're earning enough money. Sorry, I realize this stuff is a little bit dry and a little bit boring, but there's a lot of tax savings to be had there. The next thing I want to talk to you about to legitimize your business. So that step was basically having an entity. The IRS likes it when you have an entity set up that's registered with the state. Again, it shows that you're not a hobby, that you're in it to win it. You're a legitimate business. Anytime you receive more than $600 from any given client, they'll probably be, unless you're a corporation, or I don't know if they pay you guys directly or they pay the corporation. My understanding, because I'm a member, I think we pay the corporation. So we probably don't have to file a 1099, but typically if you pay somebody more than $600, or somebody pays your business, your S corporation or LLC, whatever it is, more than $600, they will probably give you a 1099. Maybe Beachbody gives you a 1099. I don't know, but that is sort of ratting on you.
Beachbody gives us a 1099, and the customers pay the company, and we get 25%. But most of our income for the people that are achieving levels of success with the goal of network marketing, just so you know, the majority of the income is passive. For those that are able to do what network marketing has intended duplicating. But I'll wait till the end, but I didn't know if it just depends. Like, there's so many levels of income from literally, there are coaches that we call them hobby coaches. So we can talk more about that after you finish, but it's interesting to hear you say that's a bad word.
Okay. Yeah. Well, yeah. I want to be careful. Because if you have losses, that's where it becomes a problem. The IRS will say, well, if you just have a hobby, then you're generating losses and it's not a legitimate business. But yeah, so kind of getting back to that discussion that I was having, if you have things that are generating the income for you, then it is passive. And your client lists and the other people that are doing the work for you, they act more like that piece of proverbial real estate I was talking about. So you can be seen as, it can be taken as passive income. Okay. So the next thing to mention is the IRS likes to see that you have some kind of advertising out there. For starters, it's usually some kind of business card. You get more sophisticated. Maybe you got a website, things like that. That again shows legitimacy to your business. Another thing the IRS likes to see is that you have separate bank accounts. That helps to show legitimacy to your business. It also helps your CPA at the end of the year when he's trying to do your taxes. If you have your expenses on already separated out easier like that. The next thing, the IRS has also looked at how much time are you putting into your business. It's a very low threshold to show the IRS that you are a legitimate business. 100 hours per year, pretty simple to meet that requirement. And then the last thing that they'll sometimes look at is they want to see that you're consulting with on the business profits. So a lot of times that will be your CPA. You can show that, look, I pay my CPA, whatever, $500 a year, and I consult with him on my business. And so that adds legitimacy to it. So those are kind of the main things I want to talk about with respect to having a legitimate business. But I mean, you don't have to register with the state of Oregon. Usually, the states, whether Oregon or Kansas or wherever you're at, don't require you to register with them until you either have employees or if there's special licensing requirements for what you're doing. But otherwise, you can just get going with your business usually and just report it on a Schedule C. Like I said, if you have the S corp, if you have the LLC, we can retroactively go back in time and tell the IRS, oops, we forgot to file for an S corporation election, the 2553, and they can I'll have clients at the end of the year say, whoa, I made a ton of money this year, and I'm going to kill with the self-employment tax. So I'll go back and retroactively file from the beginning of the year, whenever they started with the LLC. That's why I'm saying get your LLC going as soon as possible, because I can't go back any further to help you make the S election any further than your LLC started. Some of the most important expenses that you're going to want to make sure you're tracking, your auto expenses. Those were 56 cents a mile. That changes every year with the IRS rules, but those really add up. They're important. You need to keep contemporaneous written evidence, that phrase we talk about again. There was a taxpayer who was under audit by the IRS a while back for his 2012 taxes. And he gave the IRS a calendar saying, here you can see all my trips that I've done. It was a printed hard old calendar. And the IRS said, first of all, this isn't legitimate because we can see that all your appointments and dates and everything's written in the same fresh red ink, all of your calendar. The other problem is you're under audit for 2012 and you wrote it in a 2013 calendar. So the IRS disallowed all his losses and he got in trouble that way. So, just use some common sense. In a perfect world, you'd have some kind of mileage log. You don't have a mileage log, make sure you've got a calendar kept. I keep my calendar on my computer. So at the end of the year, I can go back and I can say, well, gee, I go to my Rotary Club, which is kind of a business expense, 52 times a year. It's 4 miles each way. So 8 times 52, there I got 416 miles for Rotary. Write that down. I go to my CPA twice a year, and that's a 5-mile drive. So each way. So, you can run some numbers like that and put it together. So again, automobile expenses, very important. Phone expenses. If you have a cell phone, probably going to be deductible. If you have a landline, the IRS loves that because it makes it show that you are using your cell phone exclusively for business. Sorry. Increasingly, taxpayers no longer have a landline. They just have the cell phone. So you're not going to be able to get away with, if you were under audit at least, get away with trying to deduct 100% of your cell phone expense because the IRS is going to presume that you use that cell phone for personal use, which is not deductible. Does it help a little bit if your spouse has a cell phone too? Yeah, probably. But you'll want to come up with a reasonable ratio of personal and business use of your cell phone. The same thing applies for your internet. So you've got a monthly internet fee to Charter or to whoever your internet provider is. And you'll want to divide that between your, personal and business expense. Any technology you use, if your business, look at that. The equipment that you have, again, that stuff can be tax deductible. Now, in your industry, you'll want to be very careful because a lot of the products that you use for your business, exercise equipment and stuff like that, the IRS says when it's, if things can be used both for your business and personal, they're likely to disallow it. So be careful and step lightly there. Another one is meals and entertainment. You should be, the IRS expects to see a few meals on your tax return at least. So, maybe you go out to, date night with your husband or your significant other and you, and charge it to your business. And you'll talk about some of the business and some of the things that you're doing as a business. And so those are only 50% deductible. The IRS, assumes that we 50% better when we're eating it for business than when we cook at home, maybe. I don't know what the logic and rationale there is. The next thing is your home office. The IRS has a new rule. It used to be pretty complicated. You used to have to take your home office square footage, your whole house square footage, do a ratio of that, calculate the property taxes, the utilities, the mortgage interest, and all the different expenses that are related to your home, and do a ratio on that. Not a lot of benefit, kind of high risk area, so a lot of taxpayers didn't like to do it. That rule got changed a few years ago, so you want to be up to date on that. The rule now is that you can get $5 per square foot of home office up to 300 square feet. So taxpayers are going ahead and taking that home office deduction more often now than they were before. Nice thing about being a business owner is that your medical insurance is deductible as a business owner. Normally, your medical insurance would go on your Schedule A, and it's subject to a 10% of your adjusted gross income threshold. So most taxpayers that are just on a W-2, if their employer isn't paying for their health insurance, they're kind of stuck with their health insurance expenses. As a business owner, you have that advantage. Now, you cannot create a loss in your business with health insurance, and you cannot create a loss in your business with home office. IRS is suspicious of those two. So, but it does go against your income. Another thing is travel. You want to make sure that you're taking advantage of the travel expense opportunity. I mean, if you've got to go to a conference up in Portland, you're going to take your car with you. And guess what else goes with you? Your passenger seat in your car. And guess who can sit in that? Whoever you want. So when you're traveling, maybe you go on a cruise or something that's, I don't know if Beachbody does cruises or Beachbody does conventions, or if they do multiple conventions. I mean, I go to a CPE training every year in Las Vegas. You think I can't get that training somewhere else, locally? Probably. And they have webcasts and stuff like that. But I like to do vacations, and all the better if we can get tax deductions for them, right? So look for opportunities to take the travel deductions. Some of the little strategies that you can do as a taxpayer, when you put things on your credit card, for example, that you come up on December year end, look at what your tax liability is looking like. Look how much money you earned, and maybe you want to accelerate some of those expenses into December rather than waiting till January. Even though you pay off the credit card in January, February, March, you get the expense in December, so you can accelerate expenses if you can see you're going to hit with a lot of income. There's also you want to watch out for your local municipal tax burdens. I mean, I know Kara and I have to deal with the LTD tax here in Lane County, so there's a lot of nuanced tax consequences in your local municipalities you want to be careful of. So I've been running my mouth a lot here. I don't know. Am I? It looks like I've taken up most of the time. Should I take some questions, Dylan, or what do you want me to do?
No, you're great. That is great. I had a couple of questions and comments, and then I'm sure others do as well. And you don't need to hurry on our behalf. Sometimes people need to drop off, and they might. So, no, you're great. And you're not nearly as boring as I am. Okay, so a couple things. Number one, on being a legit business, have a business plan. Is that something that we can simply Google business plan and just something like that? Because I don't have a business plan, I don't think, other than in here.
Yeah. So if you already have the information that you need. A lot of stuff that you'll find online for business plans will be for a lot of different kinds of businesses, but it's not anything that you don't already have up in your head. And like I said, you could probably put it down in 4 paragraphs.
Mm-hmm. Okay.
And 1 to 2 pages.
Okay. And then on the number 2, accounting system, you said to have an accounting system. And as far as a record of transactions, basically dates, dollar amounts, we already have that built into our Coach online office tools. So we can run all kinds of reports and export them in Excel. So doesn't that negate our need to have an accounting system because it's already built into our business tool kit?
Without seeing all of your business toolkit, mm-hmm. Again, there are going to be some, maybe there's some expenses that don't get reported there. I don't know. Does it capture everything? Oh
no, there's definitely expenses it doesn't capture, but it captures our income. What we're earning is detailed for us.
Yeah.
I thought that's what you meant by, but you mean everything.
Everything, yeah. All your expenses and you probably keep, like I talked about, you're having a separate bank account.
Yeah, I have a separate bank account.
Yeah. You probably, reconcile that bank account. So maybe when you're reconciling the bank account, just have a bunch of columns for all the different types of expenses that that arise throughout the year.
So thank you so much. I was having new locks installed during the call. Bye. Thank you so much. Okay. So my question there is, I did set up a business account within 6 months of me becoming a coach. So for 5 years, I've had a separate business account, and I use that account exclusively for all business expenses. However, there's so many weird expenses, and I'm sure my husband Jan talked to you about this. At least I asked him to. Like automobile repairs and our phone bill that I know is part personal, and if I, like, there's just so many expenses that are part personal, or, you know, like the automobile repairs. I just spent a fortune getting my car fixed, and I kind of wanted to use my business account, but I didn't. So, you know, I'm not keeping track of those per se.
Right. So, two important questions you're dealing with. Number one, when you talk about automobile, because that is an interesting area, and where the IRS gets suspicious of taxpayers. And the second is personal expenses that are, you know, mixed, personal and business. So, as a tax accountant, we expect there to be a set of books that are not tax compliant, but they're the books of your business. Okay.
Okay.
And then for tax purposes, we have usually taxpayers will give us their books for their business, and then we go through and make adjustments. And we talk to the taxpayer, and if the taxpayer didn't record, for example, the cell phone bill on their business books, then we say, "Where's the cell phone?" And then you say, "Oh, well, you know, it should be about this much." Okay. If you did report the cell phone on your business, then we say, "Look, I'm a little suspicious.
Right.
What's the right percentage?" And then you give me the percentage, and I just run the calculation there. You know, same thing applies for internet and almost everything else. And we do this enough. It's almost every tax return we can see that, you know, and we work with the client to make sure we're getting an aggressive number. There's the two terms that we work on are tax avoidance and tax evasion. Tax avoidance, good. I love tax avoidance. Tax evasion, bad. Gets you put in jail. So. Got
it. Okay, got it.
The second question you ask is automobile expenses. So the IRS has this. Let's see I was trying to remember what it was last year. So it's 53.5 cents a mile for 2017. It's 54 cents last year. Basically, the IRS tries to do an average of what it costs to drive a car. Well, I mean, that's ridiculous. Different cars get different gas mileages. Different cars depreciate faster. I mean, if I go out and buy a 2017 Ford Escalade or, you know, Porsche even, then that car, you know, every mile I put on that car is very expensive. But if I've got a 95 Ford Taurus, miles on that car are not quite as expensive. So you'll want to evaluate whether it makes sense for you to take the standard mileage rate or to take actual miles. Now, if you are taking actual expenses for your business, you have to find a way to divide that out. It gets a little bit complicated. Cars are presumed to be used for personal and for business. You know, people say, "Oh, I use my car only for business." The IRS kind of presumes that you don't. So it's always safer to use the standard mileage rate. I realize it's a little more cumbersome to keep track of the miles than your oil changes and all that kind of stuff. But excuse me, you could take the actual and say, you know, hey, I did my mileage calculation. But even then, you still got to do the mileage calculation and say, I used it 15,000 miles for personal and 5,000 for business. Well, you still had to calculate what the business miles were anyway. So if you really keep meticulous records, we can compare the two and see which one comes out a better deal. But be advised, you can't switch from year to year. Once you start using the standard, or once you start using the actual, you're locked in for that vehicle until you stop using the vehicle for business. So what about businesses that want to use their vehicle exclusively 100% for business? There's limitations. It's only a few $1,000s that you can take even with your actual expenses. So going out and buying a new car and taking the whole thing as a business expense, you're not going to be able to do that. You'll need to take a few $1,000s. If that vehicle has weighs over 6,000 pounds and has longer than a 6-foot bed for the truck, and you need it for your business, which is, as I understand it, probably unlikely with your business. But if it has those two characteristics, then you can deduct the whole thing. It's an expense called Section 179 the IRS passed recently to stimulate growth in business investments. But where it's a really sort of big industrial truck, I mean, I work with a guy that does street sweeping, and those are big industrial street sweepers, and he can deduct 100% of those because they're presumed 100% for business. But most of the cars you're working with are not going to be presumed for business, so I'd encourage you to look closely at doing the standard mileage rate.
The other thing I wanted to make you aware of, maybe Kara already has, is that we are the whole gamut in terms of earning income. I wear a couple different hats. So I have a master training business with this company, and then I have the coaching network marketing business. And so combined, last year I made over 6 figures gross. And then we have the whole spectrum of even coaches that are not making any money. They're paying for their own product. They're paying for their own BOD membership. They're paying for their own monthly coach dues. And they have like 1 customer. And that's fine with them. Like, that's fine with them. So, or they're making, isn't it like less than $600 a year in Oregon that you don't even need to file? Can you give some advice for some coaches that this isn't really this full-time like office space? I mean, for me it is, for Kara it is, for many of us it is, but for some of us it is legitimate, like it is hobby-like. Like, they love helping a couple people. They love running a challenge group on Facebook. If they can make enough money to cover the cost of their Shakeology, that's what they want. And there's nothing wrong with that. So what advice would you give coaches on that side of the spectrum?
Well, if you're any income that you earn, the IRS says you're a legitimate business, you have to report it. Okay. If you make losses, the IRS might say you're not a legitimate business and you can't report it. So, you kind of damned if you do, damned if you don't. So I would, encourage coaches to, just, really doing your best to get out there and to be passionate about what you're doing. And just because you're passionate and you love what you're doing, and everybody that I know, my brother-in-law does Beachbody down in Utah, and he's passionate about it. He loves it. Kara's passionate about it, loves it. So, I mean, if you really are creating a great product, it's not like just because I love doing it. Right. It's not work. I mean, people in this business love what they do, and they change lives, and it's a wonderful thing. So, again, as long as you're earning money, though, the IRS is going to be trying to catch you on it. And when you get that 1099, because you're earning more than $600, you're on the IRS's radar, and they're going to be looking for income. Right.
So, and that brings me to the next point, which is sort of an admonition to the team. It's kind of an admonition to myself. We have been filing taxes. My husband is super smart, and we have been using TurboTax, but it's obviously very complicated because I'm an employee and I'm an independent contractor and self-employed. So, because I work at a gym too. So it's all these different jobs. It gets complicated. And so I've had this growing fear of, what if I'm not paying enough taxes? That scares me. But I also am afraid, what if I'm not deducting enough? Because I'm conservative when it comes to like, can I write that? Should I write this off? Maybe I shouldn't. Maybe I should use my personal checking account because on some of the gray issues. So I would just encourage all of you to do these things. And Joseph, who I want to call you Yusuf so bad, jump on this if this isn't if you want to add to this, and I know you probably will. You guys do separate bank accounts if you haven't already. Find a CPA if you're in our area. I mean, Kara recommended Joseph, and that was enough for me because I trust her. So we've started to meet with him to use his services. Find a CPA, and then I think let's do those 6 steps, the business plan, the accounting system. decide. Sole proprietor, the LLC. I know I need to do the LLC thing. So that means we need to register with the state, right? We have got to go do that. And I guess we should be tracking how many hours a week we spend. Even that is hard.
Well, with that, sometimes, having email trails, you can see, that you're spending time in the business, working with clients and stuff. So you probably have a natural time, and the threshold on that is so low that unless you're the really kind of the very bare minimum. And again, if this is more for people who are generating losses, then you want to be more careful with that.
So when we go out to New Orleans for our annual coach summit that we're going to do in 16 days, we're going to be eating there. We're going to be Ubering. We're going to be paying our VRBOs. We're going to be spending a crap ton of money to become better at our business. And so what about food when we travel? What's the rule there?
Right. So when you're out of town on business, there is a per diem that you can use. And so I have clients that I have to look up the per diem rates for where they're at, because it's different for every other country. And I compare that to with their actual expenses, and I take whichever one is more. On the point of TurboTax, it has its place. And I tell clients, you could do this on some of this stuff on TurboTax, but usually not when they're business owners, because I have two clients that think it's so fun to do their whole tax return on TurboTax and bring their work to me and tell me to beat TurboTax. And invariably I can, and I make sure that I always do. But it's kind of a game then at that point. But and beat it certainly by far more than they have to pay me to do their tax return. But when you're a business owner, there's so many fluctuations in the law and opportunities to take deductions that you're gonna miss if you don't have a professional tax preparer on your side.
You have a question in the chat bar. I don't know if you can see it, so I'll read it to you. It's from Danae. She lives in Hawaii, and she's saying, can you suggest anything or have any tips for military? Because this year we will have lived in 3 states, and one of the 3 will be military housing.
Yeah, so military is kind of a unique thing, and depending on the type of income, a lot of it can be excludable, but that's kind of outside of the scope of the business. And when you have multi-state income, you really do need to get a tax preparer involved. There are some issues with residency. The CEO of Match.com last month, he had a ruling on, this is totally outside the scope, but this was a funny story. He was in the state of New York, and he was being tried for being a resident of New York because New York wanted to tax his millions of dollars. And he said, no, I'm a resident of Texas. Well, he had a house down in Texas, and Texas doesn't have state income tax. Yeah. So New York was fighting for him. And they went through this big, long trial of these millions of dollars that New York was supposed to get. And finally, the tax court decided that he actually was a resident of Texas, despite all the factors that looked like he was a resident of New York, because his dog was in Texas, in his Texas house. So that's how they came down on it. The point being, the residency issue can get very sticky and very complicated, and there's more factors than I could get into on this call to answer that question properly.
So she needs to find a CPA.
Yeah.
I feel like I'm hogging the time, and I do have more questions, but since I'm going to be working with Joseph here in Eugene, I can ask him my questions offline off the team call. I'd like to give others of you the floor to ask him your questions. So please fire. It can be out of staters too. Just unmute yourself.
Must have done a really good job. Answered all the questions.
Okay, so the first thing that you said, what were the two, Dana, I'll ask that question for you in just a second. Thank you for asking, Dana. The 2 things you were starting, I had a locksmith coming in like right at the time, and Danae was messaging me that the link wasn't working. So I got a little distracted in that first minute. that you were talking, you said there's organizational and startup. What were those two categories again, really quickly?
Yeah, so there's organizational costs and startup costs. When you're first starting your business, again, this is before you sell your first proverbial glass of lemonade, before you sell your first subscription. Yeah, so you've got these expenses that you're generating. This especially comes if you've got a new rep that's out there and they start doing it in December, and they're like, gee, I didn't make any money in December, but I had the dollars worth of expenses. How can I take that on my tax return? And yeah, you can. So again, the startup costs are costs you expect to incur after your business is going.
The first year.
Well, it can continue to go. I mean, you can continue to have these startup costs, but you can only get up to $5,000. $5,000. Yeah. The IRS gets very suspicious if you're generating losses more than 3 years in a row. You're almost guaranteed to be subject to IRS scrutiny if you've got 3 years of losses in a row.
I have another question. So I have a separate bank account where I'm having all my business expenses. I also have been trying to, I'm not very good at it, but I've been trying to collect all of my paper receipts as well and to write on them when I get my receipt back. In fact, I just did it today because I was with Kristen and she's my coach, and we had lunch together and we talked about our July business plan over lunch. And so I bought her lunch. And I wrote on there, lunch with Kristen. So I put that in is that good? Should we be right? Is that helpful? Is that wasting my time? What if I forget to do it?
Yeah, so you certainly want to have you need to have a record of all your expenses somewhere, whether it's a receipt. I mean, some people, every time they have a business expense, they, write, again, that's good. You wrote who you were with. You want to write the business purpose, whatever. If you remember that, fine. Snap a picture of it if you like to do that and email it to yourself or whatever. Keep a folder somewhere on your hard drive that has all of your business receipts sorted by category, meals and equipment or whatever it is. Or you can keep it all in a shoebox or whatever's convenient for you.
But do we need to do that if we already have a bank account? Do we need to make that extra little notation? Yes.
Yeah, the IRS wants to see that you recorded it properly, yeah.
Dana has a question, and she wrote it in the chat, and I have the same question. I have the same question about workout apparel, and I hear different things. I'm a master trainer too, and a group fitness instructor. So my job is wearing professional-looking fitness attire. Same thing for the coaches. We call it wear and share. It's advertising. We're supposed to wear when we go on an airplane or whatever. We want to wear branded apparel. Do we get to write that off, and to what extent?
So my clients never like this answer, but the truth of the matter is, if it's apparel that you can wear for ordinary use, even if you bought it specifically to promote your business, it's going to be not going to be a business expense. Now, if it has like a specific logo on it, like I'm wearing an Eisler t-shirt right now, for example, this is a business deduction because it carries the logo. But otherwise, it's very difficult to get.
Sorry.
I mean, people.
It is logoed apparel. It is, hi Jess. It is logoed apparel that we're talking about. Sorry, that just happens at my house. And then
for me, it's 7 kids, so it's
okay, good. It is logoed. It would be logoed apparel in terms of the Coach Network. But even for me with my teaching, like we are required to wear top of the line fitness apparel, and I film fitness videos for the company, and we are told to bring, I have emails that say bring it's set apparel. So I'm going to write that off, damn it. I'm told to buy it for my company. Like I go spend $500 at Lululemon. That has to be considered a write-off.
Mm-hmm. Well, I mean, again, you have to be careful. There's a lot of tax court cases that have come down on this. People buying like very nice suits because their business required it and they never wear it otherwise. And the IRS says no, because you can wear it for, other events. It's been a sticky area with the IRS, but
even if you have a directive, from above saying bring Da-da-da-da-da. Like a businessman, he doesn't have a directive saying, well, maybe he does. I don't know. It just doesn't seem right. It doesn't seem right that a company's asking you to spend money.
Ellen, if I were to take that deduction, I wouldn't admit it on this conference call to all these people. We'll talk later.
I gotcha. Okay. Who else, guys? Who else?
Okay, I'm seeing the chat now.
Oh,
Okay.
You got it. This is Joseph's first time with Zoom. Kara's got to go.
Yeah. Okay.
Bye, Kara. Thank you so much.
Thanks, Kara, for setting this up for me.
Yeah.
Another thing, if you've got kids between the ages of 7 and 17, there's a huge tax opportunity there. Each of those children has a standard deduction of over $6,000 that they're probably not using. If they were to be, working, their McDonald's job or whatever, they would be using it. But a lot of kids, particularly between the ages of 7 and 16, don't have another job. So by pushing some of your income down to those kids, they can suddenly start using that that standard deduction. So if you want to push for example, $6,300 is the standard deduction, $6,300 down to those children. If you're making enough money, push $11,800 down to each one of them, put $5,500 into an IRA, and they do not have to file a federal tax return because none of that is taxable. Your question is, wait a minute, don't they have payroll tax on top of that? If they are the employee of a parent's business, the IRS has found that they assume that the parents are taking care of their unemployment problems, their disability problems, their Social Security problems. The parents are covering those situations. So children are not, between 7 and 17 of the parents' business, are not required to have payroll taxes withheld. So, I mean, there's a huge tax saving opportunity in there if you have children.
Okay, so yeah, I have two barely still in that. I have a 17 and a 16-year-old. So I would have to have them work. I could have my daughter run my sponsorship drill down report that I do every Thursday. You mean you have to assign them a job, a task?
Yeah, so the case that came out last year on this, the name of the court case was Embroidery Express, a very successful business that these two parents were running, doing embroidery work. And they were paying their children, they had 4 children, and they were paying each of them about $6,000 to $10,000 a month for this work they were doing. Very successful. And the IRS didn't care about that. The reason they got in trouble was because on December 28th, they paid bonuses of $20,000 to $40,000 to each of their children on almost the last day of the year. And the IRS said, we're okay with all the big checks you're paying them, but you cannot substantiate that you paid them that much money. It was obvious tax evasion issue, and they got in trouble that way. So just make sure it's being paced throughout the year how you're paying those kids. And in that case, like Ellen was saying, they were doing things like licking envelopes, and they were taking out the trash, and they were doing almost janitorial type work, and they're making these huge salaries for doing it. But it was a brilliant strategy. Just make sure you can justify any big bonuses being paid the last day of the year.
So what you're saying, my 10-year-old can work for me legally, and yes. I can pay.
Yes. There are typically 3 areas of exception where you don't have to follow all the child labor laws of minimum ages and stuff like that. One of those are, and again, most of this is state issues, but there's some overlap with federal Department of Labor too. One of those is working in fields and agricultural work. Another is child actors can work without age restrictions. And the third one's when you're working for your parents' business. Just how the laws are.
Sweet. That's cool. Thanks.
You're welcome.
My son won't thank you, probably.
But I mean, my clients love it. Their kids are learning to do things. They're learning to buy their own clothes. They're learning to, they want to go out to the movies with their friends. They don't ask mom and dad for money anymore. They've got their own money. It raises responsible children. It's a good thing.
Goddamn little Republicans.
Okay, well, we can conclude. I have this recorded, so you guys can watch it back. I know I'm going to watch it back. And there are some actionable items in here for us. I think everyone who is on this call, everyone who watches the Jake's chat is out of control. Joseph, don't even read the chat. It's out of control. There are actionable items for all of us. And so you guys know I'm a big fan of encouraging you guys, of encouraging myself, not to just be a receiver of information, but to be a practitioner. That means we don't just need to like sit here and learn and oh, wow. And we need to learn and then go put into action. So you guys should all have some homework to do after tonight's call. I'm super grateful for your time, Joseph. I wish I had collaborated with you a few years ago. But in any case, it's never too late to get better on the right track with your business. So, all right, you guys, thank you all for your time. Joseph, thank you so much.
I've enjoyed it. Thank you.
All right, guys, peace out.